Video lesson 3.7 Peak Fractal Levels. Alright, getting started with this video lesson. This is a very unique video lesson that we are going to start digging into. These levels happen on micro and macro scales, so it's really important to understand the different time frames that you're looking at and just seeing the different levels in each time frame. So you can do this. It works best on either the 4-hour time frame or the 1 hour. For me, I use either the 1 hour or the 4-hour time frame, usually a macro time frame. But like I said, the levels occur on all time frames. So on the 1-minute chart, there will be levels just like on the 1-hour chart. Obviously not as large, obviously on a micro and a macro scale. But anyway, this happens on every pair. All pairs have different levels. They do form these levels, but each pair, as we know, is different, has different characteristics, has different, gold is a much more volatile pair than the euro, but if you analyze both of them, you'll see the same amount of levels in each pair and the same characteristics that I'm going to be showing to you here. So these are a few universal characteristics that I have picked out for you guys that will work on every pair. I am just going to use in this example gold versus the US dollar just because it is what I'm using right now, what I graphed out, and it's pretty clear. You can see the levels pretty clearly, but like I said, it does work on every pair, and make sure when I'm going over these characteristics that you take notes and you start to understand and really look for these different characteristics that play out. So Forex and the law of threes. Why does Forex obey by a law of three? Well, many structures are based on levels or cycles of three because of how we've been conditioned as humans. For example, you've been saying 3 strikes you're out, or 1, 2, 3, or for example, retail traders will look for a third hit to a trend line as a confirmation to validate a trade. These are all psychological things that we look for to create our bias. Now, these are also characteristics that the market obeys by just because of the participants. We are humans. We are participating as humans in this market. So another example is 3 days into Forex is the middle of the week for the most part. So Monday, Tuesday, and then Wednesday. Wednesday is the middle of the week. And many times there will be a 3-day swing in one direction. So the market will trend in one direction, uptrend for 3 days, or downtrend for 3 days. And then at the third day, which is usually Wednesday, there will be a midweek reversal induced by news. So this news-induced reversal will happen after the third day. So just imagine you as a retail trader, you start trading Sunday into Monday. Monday you get into a trade long on the euro. It goes up and you finally get into profit. After 3 days you're in profit, and then on Wednesday the market reverses via a high impact news event, and that news event just is so volatile that most times you don't even have time to react. You don't even know what to do. You freeze up and you just watched 3 days of work, 3 days of profits go down the drain within a few minutes, within 15 minutes. So this will happen to millions and millions of retail traders on a weekly basis. This is a weekly cycle that occurs. Now, this will happen on a macro and micro scale as well, but you need to realize that the weekly scale is where it's mostly affected because of the news that is mostly taking place, the high impact news at during Thursday or Wednesday or Thursday. So the middle of the week. And you can go on Forex Factory or whatever news calendar you use and check every single week. You will see it's not a coincidence. Every single week on Wednesday is the most news, high impact news. So all the red folders, all the 3-star news events will happen on Wednesday. Not all of them, but I'd say most of them for that week. Most of the news events in general. So the 3-day swings. Now let's go into gold. Let's dive into it and see how the law of three, these 3 cycles, play out. Now, I've just graphed a little bit for you guys. I'm not going to go and graph out a year's worth of cycles, but this is just the past few months, all the way back to May, and we'll even go a little further here, back into April as well. But just so you guys can see the law of threes, there will be 3 levels in a trend. So take this trend. Actually, let's use this trend as an example. Now, this is clearly an uptrend, correct? But before it was an uptrend, it was a downtrend. That's pretty obvious. Now, thinking on that level, if we are trading this downtrend, when will we know when the trend is going to reverse? So, actually, let's go back a little bit more. Remember, I talked about the retail traders using 3 hits to a trend line as confirmation in their bias. So let's use that, right? Let's take that and use that, because I'm pretty sure this is on Baby Pips. You can go read it. Not 100% positive about that, but I'm pretty sure it's on babypips.com. I was taught that. Every YouTube video on YouTube that talks about trend trading in Forex will tell you to sell the third hit on the upper trend line in a downtrend, or vice versa in an uptrend. Let's see. Okay, here we have downtrending market. We don't really know it's a downtrending market yet, right? Because here it's obviously uptrending. So let's see. Here is one hit. Here's the second hit. Now, upon seeing the second hit, we can safely say now retail traders are starting to graph this trend out. Okay? Now retail traders are finally catching on to this downtrend. So the trend was touched there. The trend line was spiked there once, twice, and then here at this bottom we have a touch. So retail traders are now starting to graph trend lines here as well, and now they can see this channel. It's starting to become obvious. Okay, let's look to sell as retail traders at this level, the next hit on this trend line. So what does the market do? Rejects the lower trend line once, and then one more time, and then it comes up just as we expected to our trend line. But wait, it got right to it, and then it fell here. Ooh, what are we going to do about that? Are we going to sell here, or are we going to wait? Are we going to get in as retail traders? Are we going to get in and sell, or are we going to wait? That's the question. For those that waited, they may have sold and adjusted their trend line a bit so that it confirmed to them that it was a sell. You see, this is all confirming to yourself. You're confirming your own bias as a retail trader, and it's all by using the tools that and the mindset that we're taught to use. So it bounces off the trend line here. I bet you retail traders start piling in their sells here. Consolidates a bit, pops up one more time. You can see that doji, or whatever they call it, whatever the retail traders call it, the star formation, above the trend line. Not quite above it yet. If we're still adjusting our trend line to go with our confirmation. So here we go. It's still confirming to us that it's a sell. Retail traders start selling here, and then what happens? Any retail traders that sold here, I'm sure, had their stop losses right above this high. So in this general area, what happens? One bar comes up to hit the stop losses, takes them out. And then what happens next? Next is one bar down, almost equivalent to this bar. What does this bar down do? It entices the retail traders to get in again because they think it's actually reversing and this is a better time to sell because they see this big structure here, this big stop hunt. They were stopped out. Oh, let's get in again. Sell, sell. What happens? It consolidates a bit more. They go into a bit of profit if they sold. And then that profit gives them it boosts their testosterone. They want to get in more trades. They trade more throughout this consolidation. And then it slowly comes back up. Where is their stop loss going to be? Their stop loss is going to be above this high. That's obvious. What happens? One candle, boom, takes out their stop loss. And then finally they realize, oh, maybe it's uptrending. Maybe we're in the wrong direction. They don't know it's uptrending until that third hit. So what do? They graph their trend line out. They graph the first one, the upper, and then they graph the lower, right? And then they won't really see the lower trend line until they're at this point in time. So until this happens, this lower trend line won't really be graphed by a massive sum of people. Now, until this is met here, price bounces off this trend line right here, or this area, then this trend line will be graphed. Retail traders will start to graph this out. It'll be obvious. You guys have to see this. Now, what are retail traders going to be looking for? That third confirmation, that third hit. 1, 2, 3. Oh, we got a third hit in the trend line. That was a very volatile spike as well. But it still gave retail traders that that confirmation that it was going to go up. And what does this really fast move? What does this, this wick represents a really fast move. What does the really fast move do? Basically, the really fast move gives the representation that it spiked down, price spiked down, and it's going to come back up. But it didn't give retail traders enough time to buy in this area to make profit. It spiked down very fast, most likely in a news event, and then came up, consolidated in this area. What happens here is retail traders define this low. Now, since they didn't have time to get in at this low, they will they will buy in this area that they were given to buy in and place their stop loss at that low or below the low or even below this trend line here, all the way below the trend line. What happens next? Ding, ding, one candle stops them out. And then it's just that cycle, you guys, over and over and over. And I'm sure we've all gotten caught up in it. I have gotten caught up in it many times. Even to this day, I get caught up in it sometimes. But it's a mind over matter type of thing. It's all about erasing what you've been programmed to see and trade what you actually see Trade what is actually happening, not what you think is happening, or not what you have been programmed to believe is happening, but what is actually happening. So, believe it or not, this is the end of this video lesson. No, I'm just kidding. We are just getting started with this. Like, this is really in depth, and I'm sure you guys, this is blowing your minds already. But it is just the beginning. So, each trend has 3 levels. Now, each level has a corresponding level of consolidation. So let's clean up our charts a little bit as best possible. Now we can see this is where the head and shoulders pattern comes into play. Head and shoulders patterns happen all the time, but unless you know why they're happening, unless you see the structure, then you won't really know why or how or what they're for, why they're forming. So, like I said, each trend, take this uptrend for example, or this downtrend, each trend has 3 levels and a corresponding level of consolidation. So, level 1, here we can see level 1 and the consolidation inside of level 1. Now, just to show you guys the levels a bit clearly, a little bit more clear, I'll use this to separate the levels a bit more, because sometimes it's easier to see them if you separate the levels from the consolidation, because the levels are separate from the consolidation, but the consolidation happens inside the levels. So it's kind of confusing, but in time it gets all that much better. So you'll definitely learn a lot just by back testing and going over different pairs. So level 1, level 2, level 3. 3 levels in this downtrend. Now, what about this here? Well, this is what we call the peak. This is the peak fractal, or the peak of that level. Now, every peak consists of a head and shoulders pattern. So, after 3 levels, if you see a head and shoulders pattern and you're sure of the 3 levels, then you can start to look for the reversal, but not until you see the 3 levels. Now, let's go more in depth on the levels. Like I said, there's 3. There can be more, but there is an average of 3 levels. And it always depends on which time frame you're looking at and from the perspective of which you're looking at it. So if you're looking at it from a micro or a macro perspective. Now here we're looking at the 4-hour time frame from I wouldn't call it a macro or a micro, but it's kind of in between. So the macro I think would be more like this trend, and the micro I think would be like these little trends. So this downtrend, this uptrend, downtrend, but this is somewhere in the middle. So looking at the levels, we have inside of the levels corresponding levels of consolidation. Now, this is how you guys are going to define your levels by the consolidation. Level 1 and level 3 are very similar. Level 1 and level 3, and I'll tell you why they're similar more in depth when we get onto the head and shoulder. But right now, 1 and 3 are very similar because they are straightaway levels. They're fast, and they tend to be shorter and smaller than the second level. Now, all of the levels tend to have the same range. So what do I mean by that? What I mean by that is level 1 consists of about 200 pips here. Level 2, same thing, 200 pips. And then level 3, 200 pips. So each level has about the same range. And then that will help you define the levels. Remember that. I hope you guys are taking notes, writing all of this down. Now, the second level is what will help you realize that you are in the second level, and that the third level is coming up, and that the reversal could be happening. So what are the characteristics of the second level? The second level is usually usually takes twice as long as the first level. So the first level took about 5 days, so about a week. The third level took 5 days as well. The second level took 10 days. So the first level took a week, second level took 2 weeks, and the third level took a week as well. Now this second level will be the slowest of all levels. It will be the level in which consolidation happens the most. There will be the most consolidation happens in this level. We can see that very clearly throughout each trend. Now let's go through here and just see what we have. Just by looking at this, we can see the levels here very clearly. Here is, well, if we want to first define the peaks, let's define the peaks first so that we can then see the levels, then define the levels. So here is the peak of the downtrend that then forms the uptrend. Here's this level 1. You can see the breakout. The breakout determines the level. Breakout of level 1 here. And then so here is the level 1 consolidation. This is level 1. Here is level 2. And then here is level 3. We could maybe even say something like this. Level 3, level 2 here. It's really a personal preference type of a thing. Everybody sees levels a little bit differently, but they're universal. They are universal. Now you could say this is level 3. No, there, like I said, there's all kinds of different ways to do it. Or this is level 1, level 2, and then level 3. That could very well be true as well. So let's box in the consolidation just to show you guys. Level 1, level 2, and then the third level. So let's graph the trend as well. Now you can see trend is graphed. You can clearly see the levels inside of the trend. 1, 2, and level 3. Now, if you have not noticed already, there's a pattern going on. that's pretty obvious, but there's a different pattern than what you're thinking of. The head and shoulders pattern is what I'm talking about. Let's just look over some of the things we've talked about, things we've discussed so far. Law of threes, levels of a trend, consolidation levels, head and shoulder peaks. We've gone over midweek reversals, 3-day swings a bit, micro, macro, stop loss, and take profit levels of retail traders. We'll go over that as well. So, head and shoulder peaks. What is that? This is the pattern that I was talking about. Let's erase some of these. They're kind of ugly. So head and shoulder peaks. We can see this most clearly right here. Now I'm going to give you guys the only reason the head and shoulders happens. Very, very easy to understand. Here's our head and shoulders tool. We're going to take it, draw out our head and shoulders. Now, what do you notice anything? If anything? If anything, what do you notice? This is where I really get excited because this is something that just really, it's really exciting. It excites me. It's something that very few people know. understand or talk about. We can also see inside of this macro Head and Shoulders, there is a micro Head and Shoulder pattern. And I also have the peak of that circled as well. And that just so happens to be, whoa, what happened? That just so happens to be inside of our peak. So here's the micro Head and Shoulder inside of the macro Head and Shoulder. What do you see here? If it's not already hinted enough. 1, 2, 3. Head and Shoulder. 1, 2, 3. Alright, I guess I gave it away. Level 3, which is the end of the trend. Upon ending that trend, the dealer has to induce retail traders long. So let's say it's an uptrend. He has to continue inducing retail traders long and continue getting them to think that the trade is going long, and then uses that. So the continuation of that trend creates the head of the Head and Shoulders, the peak formation right here, this trap. This trap is what will trap retail traders long in the wrong direction, and then reverse and start the new trend. So what does this mean? Level 3 and level 1. So the Head and Shoulders is used to connect level 3 to level 1, but trap at the same time, trap as much liquidity at the peak as possible. This is the only reason level Head and Shoulders forms, you guys. You can see it all over the place. Level 3, the peak, get the retail traders to believe that price is going to continue down, and then connect level 3 to the reversal, which is level 1. So looking at this even a little more in depth, let's go on the 1 hour chart so you guys can see it. Remember I said there were 3-day swings. Alright, so here's level 3. Here's our day 1. Day 1 of the downtrend. Day 2 of the downtrend. And then day 3 of the downtrend. What do you know? there's a head and shoulders pattern connecting day 3 of the downtrend to day 1 of the uptrend, and then we can see the 3 days of rise, or the 3 levels as well. Here is the mini peak. 3 days down, 3 days up. Obviously, this isn't going to happen every single day on every single pair, but it's just something to keep in mind. It's just a part of the structure, you guys. So just keep that in mind. Just understand the dealer is always working in 3s. So I believe the last one that we are going to talk about is the stop loss and take profit levels of retail traders, where the stop losses may be, where the take profits may be, and how we can see this on the charts. And I'm sorry that these blue lines are here on the charts. I can't seem to remove them right now, and I'm not sure why. I'm gonna have to restart the browser after this video. But so here we go. The stop loss and the take profit zones of retail traders. Now, after 3 levels, let's take this for example. After 3 levels of that continuation of that downtrend here, that 3 levels downtrend, I explained to you that earlier that retail traders would sell in this area. Their stop losses would be above that high. Alright, I guess we did kind of talk about the stop loss and take profits, but we didn't really talk about the take profit zones. So why does the trend reverse at the 3rd level? Not only because of the 3rd hit in the trend line, but at that 3rd level there are going to be too many take profit areas or zones, take profit orders down here of the retail traders. So the dealer will spike and create that low, and then the retail traders will sell and have their take profits below that low or at the low, and the take profit will not be hit because, as we know, that low price will not go any lower than that low, because that is the peak, that is the determined peak of that level. The peak has already been determined. The peak 3, peak 3, peak 3, peak 3. Alright, and now we can see on gold how do we trade these levels? I've told you guys how they work, the characteristics, but how exactly do you trade them? Now, I personally do not look for levels when I am entering my trade. I'll obviously look to see if a reversal is possible or if we're in a level 3 scenario, because level 3 is usually the easiest to determine. But as long as I have grabbed the second leg of the W or the M formation, I will ride that trade until I see the levels clearly. So it's really an after the fact, at least for me. I use the levels after the fact, after I get into a trade. So if I know the trend is uptrending, I know the market's uptrending, I will look for W formations. I will look for second leg W's to enter on. So an example of that could be this W here, the second leg. I would enter here. This W here, the second leg, you could enter here as well. And then you could take profit at the breakout of the third level. You could see, well, level 2 was here. This is level 3. And then we have that continuation. You could take profit at the peak if you realize that this is the peak. Now, it would be somewhat easy to realize that this is the peak just because of the head that we see forming here. The head connecting level 3 to level 1. Now, just in case we're wrong, because we could very well be wrong, this could very well not be the peak, and we could go up another level. But that would mean that we would just have to adjust our levels here. So let's say price continues to go up and breaks the peak. Now, the reversal is valid until the peak is broken. Always remember that. Until the peak is broken, the reversal remains valid. So what would we do if this peak is broken? What we would do is readjust our levels. We would consider maybe this to be larger of a level than we thought. This is level 1. This may be an entire level 2, and then level 3 could be possibly forming right now. We could be in level 3, and this could be the left shoulder of level 3, and that peak could be forming right now to then create a reversal and then level 1 and so on. So always be aware that that is a possibility, you guys, that you could be wrong, that your levels could be wrong, and that you need to adjust. Or that you could be looking at the levels on a different point of view, from a different perspective, from a micro perspective when we need to look at the macro. So this could very well be so looking at this from a very macro perspective, this could be the peak. This could be level 1. and then this could be possibly level 2 to a very huge, very large uptrend that could be forming level 3 right now. So you always have to you always have to remain on that, looking at that next level perspective, be on that next level of awareness. So this could be level 1, this could be an entire level 2, and then level 3 could be forming at the break of these peaks here. But we don't know that until it happens. So like I said, trade what you see. Alright, this is probably going to be a wrap up, you guys, for video lesson 3.7. I had a blast in explaining the levels to you guys. Hopefully you enjoyed and learned a lot. So yeah, until the next lesson, thank you for watching. Enjoy.